Learn the secrets of cash flow and start building a lifestyle-friendly business today. Give it up for Cash Flow Mike.
A year ago, I met Roger Connect. A year ago. 6 months after that, I'm on his podcast. 6 months after that, here I am. What an amazing journey. Thank you guys for allowing me to be here. Really, really. So, what's funny about the intro, the bio, people say, hey, send me your bio. I didn't like it. Right? MBA, all this other stuff. Didn't like it. So I'm like, I'm going to tell the story. How does it start? Well, it starts with having a problem, going through the problem myself. So here's a war story. See if you resonate. I was fighting the Battle of Typewriter Hill. Fort living room, armchair division. And then it happened. You know the one, the pain, the one you see before you feel. Nastiest paper cut I ever had. Okay, so why start there? Why are you going to start off with something like that? Because we all fight battles. We all fight wars. Mine just included some other things. I had 24 years of commitment to SMBs. Now, my first job, anybody want to guess? Liz might know it. First job. State trooper in St. Louis. You can see that, right? Probably see that. But after that, my family outgrew my income. And so I had 14 startups after that, right? So all the things that happened became part of this program I created called the Clear Path to Cash. 8 steps to maximizing cash in any given business situation, right? So I help business owners maximize cash. I help accountants build advisory services. I do both. The result of the war was over 20,000 people have been through the Clear Path to Cash. Bankers, accountants, and business owners. I've taught anywhere from Wells Fargo all the way down to Hills Bank in Iowa. I've found $150 million in hidden cash for my clients. I found $8.8 million this year already. I have helped businesses secure over $500 million in funding and increased my clients' business value by over $1 billion. So that's the result. Now let's talk about the pain. Talk about the pain. There's order in chaos. There's order in chaos. Now, close your eyes for a second and think about you're in a festival or a crowded mall. You like it? You see it? You see what's happening? You see the people? Is it chaos? Does it look like chaos? Yeah. But now take and focus on a person. That person's got a plan. That person's got an idea. You can see them bobbing in and out. You can see them going into a store. The purpose becomes clearer when you have a little bit of focus. Trees are the same way. Look like a bunch of chaos until you look at the leaf. Well, businesses are the same way. Businesses are the same way. So my goal for you is to teach you about my program or it's not a program, it's a technique called the Home Run Financial System. And I want you to leave here thinking it's the thing you got to do with every client every time. Now, the reason I say that is it is the basis for this book. I wrote 2 books. One is the 7-Minute Conversation. The other one is Don't Be a Dumb Business Owner. Right? Now, when I say dumb, I don't mean unintelligent. I mean, don't understand my business. Right? I don't understand my business. That's what it means. How did I come up with it? Yeah, I was dumb. I sat there and go, man, I got to be dumb. I can't figure this out, right? I just don't understand my business. And then you know how bells start going off? Hey, wait a second, that matches. So we talk about order and chaos. Here's what made me think about this. You're like going, yeah, festivals. Oh, I'm sorry, this here? All right, the 7-minute conversation normally takes me 90 minutes to teach. We got 40, 35. So I'm going to go over the high strokes. If you want to know step-by-step the numbers, go to cashflowmike.com. Just download the ebook, and you'll have step-by-step and all the calculations and how to do it. So everything I'm going to show you, you got the copy of the book in your hand. That's what I'm showing you what it looks like. Header page, just download the book. Okay. So order and chaos. You're saying, Mike, crowds and what's the next thing I said? Leaves have nothing to do with business. Well, who's been to Starbucks? Anybody? What does something cost at Starbucks? No, can anybody name a price at Starbucks? All right. Here's what I learned about Starbucks. First of all, if you go to every Starbucks, they're going to have different prices. One day, come out of my office, go over to Starbucks and say, I need a grande caramel macchiato. They say, yes, sir, $4.54. No problem. 3 months later, same barista, same order, $4.67. What just happened? Yeah, what inflation, right? Here's what I learned. They do this thing called active pricing over at Starbucks. Every 3 to 4 months, they put 5 to 15 cents on every product until decline goes down or the demand goes down. It's called the price elasticity of demand. You guys remember that from school? You raise price until demand comes down. They're doing it to us, man. They're getting us. But it's active pricing, so they can maintain high profit margins. But that's not what we're going to talk about. We're going to talk about the epiphany moment, the moment that I knew that I had to figure this out. That's a picture of me and Pudge. He's like a little Yorkie poo type thing. Yorkie, I don't know what it's called, but he wasn't but this big. But what you can't see is on the desk, I have almost 100 companies' financial statements. You see, before this time, that's when I ran into all the cash flow problems, I figured it out. I figured out about this thing called the financial gap. It's the difference between money coming in and money going out, and how to balance it and how to manage it. And when I learned about managing and pulling levers on the financial gap, I opened 27 offices in 9 states in 3 years. Became one of the largest hotel staffing companies in the country. And with that, somebody bought me, right? So in 2011, I got bought. So I'm sitting on a bunch of cash. I'm playing golf every day. You're like, well, what am I going to do with my life? I was only in my 30s. So I'm looking at companies to buy into. And what I didn't like about staffing is that every time I wanted to grow, I had to open another office or get more accounts or hire more people. So I got into software. Anybody ever heard of cash flow tool? I built cash flow tool, right? If you've ever said, he looks familiar, I'm like Clippy in cash flow tool, right? Like going, explain this. And I come up and go, a current ratio is, and tell you what that is. So with that, a company bought me, I'm sitting on cash, and so I bought into software. But here's what happened. I had 100 different companies' financial statements on my desk. How do you make sense? What do you buy next? Who do you buy into? Who do I invest into? I had no order. I had no process. Everything looked like chaos to me. So I said, okay, well, I've got to figure out a way to sort the good ones from the bad ones. So I created what I call the home run financial system. Here's why I call it that. Any baseball fans? Baseball? Yeah. Anybody heard? You've heard of a home run? All right. I call it that because it touches all the bases. It touches the income statement, the balance sheet, and the cash flow statement. And it's only 6 calculations. It became the basis of the 7-minute conversation because you can do these and explain what's happening in any company in 7 minutes or less. Here's what it looked like. Start off with the income statement. Now, you got the income statement, balance sheet. Sometimes people go, oh, I just run it off the bank statement. Anybody run their business off the bank statement? Here's the thing about the bank statement. It's going to tell you if you have a good or bad day. Do I have money or not? The income statement is going to tell you if you had a good or bad month or quarter or year, and it starts over. How does it start over? How do we just say, man, we blew it in January, let's go get them in February? How does that happen? How does it get to start over? Anybody? Net profit, the result of the income statement, gets wiped off the income statement and put on the balance sheet in the form of retained earnings. So it gets moved off the balance sheet and moved. That's how it gets to start over. Now, I've got 3 different calculations that I take from the income statement. The first one's trends. We kind of all go there anyway. Sales, gross profit, operating expense, net profit. Sales is pretty easy. You can tell if it's going up or down. But if you listen to the way I do it, I never say percentages. Who knows why? Percentages scare people, okay? 2%. See, it doesn't scare anybody. So that was the dumbest thing I've ever done right there. That was probably the absolute dumbest thing I've ever done. And it came right to my head, I should never listen to me. So, but anyway, I don't do it because, well, let me ask you. If you go to the grocery store, how many gallons of milk can I buy with 2%? Yeah, doesn't make sense when I say it, right? How about 7%? How many gallons of milk can I buy with 7%? Anybody answer the question? That's why I don't use percent when I'm talking to my clients. I use dollars because as soon as you say percent, somebody has to convert it to dollars to understand the magnitude of change. If I say we increase by 10%, that could be $100, that could be $1 million. But if I tell you you increase by $1 million, it has more impact, more gravity. Now, gross profit to me is the most important number on the income statement. It's the only place that you can get money to pay your bills or put in your pocket. It's the only place you can get cash is gross profit. So I pay a lot of attention to that. So, hey, I got a story. All right, gross profit. Burger King ran into a gross profit problem. They got this sandwich. You guys remember the what's their thing? The Whopper, right? The Whopper. Now, when they have the Whopper, what do you think they want you to buy? No, they want you to buy the Whopper, right? Home of the Whopper, because they want you to buy the Whopper, right? Okay, there. So they want you to buy the Whopper. So they were the first people to build the value menu, the dollar menu. And they didn't put the Whopper on the value menu. They put another sandwich. What was it? What is it? Whopper Jr., right? For $1, Whopper Jr. The moment they did that, gross profit decreased like a rock. Fell off the edge. Because here's what happened. A guy like me would walk in and go, Whopper, $3.63. Whopper Jr., $1. I'll take 2 Whopper Juniors. That's how people were ordering. Why? Cheaper. But then Burger King's only getting $2 instead of $3.63. How'd they fix it? Anybody know? How did Burger King fix that problem? Yeah, close. Anybody else? All they did, okay, so who does the value pricing where you put things in buckets? Like, I have a gold package and a bronze package and a polka dot package, right? Who does that? People do it though, right? Why do they do that? It's called the Goldilocks theory, right? Who said it? Options. All right, so Burger King already had burgers and the buns and the garden stuff and everything to make a Whopper. They go, you know what we're gonna do? Double Whopper. So they put a double Whopper together and they don't care if you buy it. Don't care. I'm probably the only guy in America that's bought one, right? And it sits like a bomb like this. I mean, you can tell. Right? And I love them, they're good. But, but they don't care if you buy it. They want the guy to walk in there and go, Whopper, double Whopper, Whopper Jr. I'll take that one's too big, that one's too little, that one's just right? That's the same way people package their prices. Big, small, medium. So that's how they fix that, the gross profit problem. Now, when I talk about trends though, it isn't just about dollars. Is it going up or going down? I talk about the relationship. Is sales going up good or bad? Sounds bad, right? We're doing less sales. What about gross profit? If it's going up or down? If it's going down, is it good or bad? Bad. Now, when you talk about relationships, if sales are going down, do I expect gross profit to go down? Okay, tell me why. She said, it depends on how we package it. So sales are coming down, gross profit may come down. So let me ask you different. If sales is coming down, but gross profit is going up, is that good or bad? Yeah, because I'm doing less work, making more money, right? Less sales, more gross profit, more cash. All right. So that's the relationship I talk about. Do I expect it, for one? And two, is it good or bad? The second part of it is, the third part is operating expense. Now, if sales is coming down, do you expect operating expense to also go down? Do you expect it? Yeah, sales is coming down. Do I expect operating expense to come down? No. Who says yes? Who says no? Who says I don't care? All right, so yeah, it's one of those things where you don't expect, I can expect if somebody is managing the gross profit, I can expect that when sales comes down, so does gross profit. But operating expense doesn't move with sales. It takes a manager's decision to add or subtract. To add or subtract. It takes somebody to say, let's add it or let's subtract it. Don't expect it. So if you see operating expense coming down, is that good or bad? Could be good. Could be good. How about net profit? Net profit's coming down. Good or bad? Yeah. That's the result, right? We did all that work for nothing. So that's the result. So, and you can't do anything to net profit. You have to change sales, gross profit, or operating expense. Net profit is just a result. So that's the first one, trends. Second one, expense control. So I take the trends and create the second calculation. Expense control. There is a hard rule on expense control, and if you violate it, your company will die. All right? I'm not lying. Company will die. It is if gross profit is decreasing, the change in operating expense should mirror that change in gross profit. Let me explain it easier. Gross profit is the amount of money you have to spend. Operating expense is how you spend it. If I have less money to spend, I should spend less money. You do it at your house. Why don't you do it in your business? If you took a $2,000 a month pay cut today, would something have to change at the house? I mean, you still might be able to make your bills, but maybe you don't go out as much, or maybe you don't save as much or invest as much. Something has to change. It's the same thing in your business. If you have less money to spend, you should spend less money. So that's operating expense. If you violate that, your company will die. Let me explain. When operating expense is higher than gross profit, so the amount of money I'm spending is more than the amount of money I'm bringing in. What's that point called where those two are equal? Break even, right? I call it practice and working. Because we don't do it for money. We just kind of go to work, do stuff, and then go home. But we don't do it for money. But how long can you run? And before I ask that question, before you answer the question, how long can I run with operating expense over gross profit? All right, let me ask you a different way. I was a state trooper. You go to networking events, people ask you questions all the time. Like, what do you think they ask a state trooper at a networking party? Anybody? Yeah. It's normally like this. They go, all right, Mike, come on, be real. How fast can I drive? And my answer was the same no matter who asked the question. It's always the same. Who's got an answer? Who knows what I would say? Speed limit? Boring. Boring. See? All right, here's the answer. You can drive as fast as you can afford. Right? If you can afford a $50 ticket, just drive that fast. If you can afford to go to jail for the night, drive that fast. Just pick one side or the other, right? All right, so expense control. So if that's the case, I can drive as fast as I want to as long as I can afford it. I can operate with spending more money than I bring in as long as I can afford it. And there's a point in time when your company dies. The last one is EBITDA. Who knows what that is? Yeah. Let me make it easier. Instead of saying all that, just say cash flow. It's a substitute word to bankers for cash flow. Unless somebody has a relationship with the bank, they're not calling you saying, hey, what's my EBITDA today? They're not doing it. But here's how you can use it. Right? Here's how you can use it with your business owners or your clients or yourself in a real world way. Anybody ever applied for a loan with a bank? No? Anybody had this happen? Hey, Mr. Banker, I need $1 million loan. They ask you for papers this much. They take it in the back room. 2 weeks later, they come out and say, no. They might not even say no. They'll say, not $1 million, but we'll give you $500,000. Right? They might feel like a negotiation, but it's not a negotiation. Because you might go, okay, I'll take 750. No. What they've done is a calculation with EBITDA where on average in all banks, there's a little bit of variance, but the cap on long-term debt is generally 3 times EBITDA. It's important to know. If your EBITDA is 100,000, what's the most they'll probably give you in a long-term loan? 300,000. That's important to know. Most people don't know that. They'll go into the bank and go, hey, Mr. Banker, I need a loan. That banker will ask you what? How much you want? And you go, I don't know how much you give me. When you do that, that's the first step to telling the banker you don't know what you're talking about. If you have to ask them how much they'll give you. This is telling you how much you can afford. There's another purpose for EBITDA as well that banks have. EBITDA puts everybody on an equal playing field. It takes out all the effects of managerial decisions, financing decisions, and accounting decisions. Let me explain. When we add back in depreciation, amortization, we're taking out all the effects of different options to depreciate and amortize. You might use straight line. Somebody else uses double declining balance. If I add it back in, we look the same on paper, cash-wise. You might use debt to finance your company. Other people use investors, equity. If I add back in the interest, we look the same. So what the EBITDA does, it puts every company on a kind of an equal playing field. That's another way you can use it. All right, next one is the balance sheet. All right, so this are screenshots out of a spreadsheet that I use to do all these calculations in seconds. But usually I'll say, hey, you're down $1 million, you're down 500,000, whatever it is. Expense control talks about the change in gross profit. The other thing is I like to give people the options. So out here, it says you should cut operating expense. That's what I'm doing. I'm not just saying that you're spending too much money. I'm going to tell you exactly how much you need to cut. And then EBITDA, there's one on here that's supposed to be borrowing power as well, but it helps calculate that for you. All right, the balance sheet. How many people use it? How many people know how to use it? Okay. How many people have clients that just go, that number matches that number, bookkeeper's killing it. That's about how it goes, right? They're doing a good job, man. These things match. I know they're supposed to match. Well, here's the thing. Remember how the bank statement is about a good or bad day, the income statement is about a good or bad month, quarter, or year. The balance sheet says if you have a good or bad company. It is the culmination of every single decision you've ever made. Everything you bought, how you financed it, everything you own, everything that runs through the company, it's on the balance sheet, and nobody knows how to use it. They just look at totals. So here's 2 calculations you can do. One is debt to equity. What I like about debt to equity is we talked about, I think it was a CFO project, said here's 6 people that people go to for advice. It used to be you had 3 people on your team when you had a business. Who were they? Accountant, lawyer, banker, right? They were kind of all on the pedestal with the small business owner. After 2008, when the bankers burnt the world down, remember that? People stopped talking to the bank. Just stopped doing it. Matter of fact, I do surveys in all my group coaching courses. I say, hey, who do you go to for advice? You know where bankers rank now? Not in the top 3 anymore. Where? All right, still in the top 10. They're 7th. Behind other. So people are going to anybody in the world saying, hey, Joe, let me tell you about my business, rather than go to the banker. Now, here's why it's important. This ratio here, you're like, oh, man, it's a ratio. It's math. No, this is the ratio that gets business owners in trouble because 2 people they love and trust are giving them advice, but it's opposite advice because the equation is debt divided by equity, D divided by E. Both the banker and the accountant have different motivations. The banker wants to do what? Loan you money, right? That's how they make money. They give you a loan. They want to loan you money, and they loan it against the equity that you have, your skin in the game in your business. What's the accountant's motivation? Save taxes. What do we pay taxes on? Everything. I took 4 breaths today, Mike, taxed. I'm on the breath tax system. No, but normally income tax, right? Yeah, so we get taxed on income. Income gets moved off the income statement to the balance sheet in the form of what? Retained earnings, which is part of what section of the balance sheet? Equity. So the lower my net profit, the less equity that goes on the balance sheet. If I have losses on the income statement, I have losses in my retained earnings. When you buy a house, how much does the bank typically want you to put down of a purchase price, percentage-wise? 20%, and then they put in 80. So 80 is the debt, 20 is the equity. 80 divided by 20, use your calculators. What is it? Somebody went through it. Oh, I got it. 80 divided by 20, who's got it? 4. Here's what it means. You can't just say, yeah, I got a 4. Here's what it means. For every dollar you put in the house, you let the bank put in $4. That's how you read that stuff. For every dollar you got in, you let them put in 4. Now, the higher that number is, the more risk to the bank. What if they let you put in 10%? That means they put in how much? 90 divided by 10 equals 9. They got more money in, so more risk to them. The higher the debt to equity ratio, the more risk to the bank. Now, they're not going to give you 4 on your business. Who knows the real answer? What's the answer to the banking test there? Who knows what they will give? It's 250. Write that down. If you see debt to equity, 250 or less, 2.5 or less is the answer to the banking test. So if you're looking for a loan, calculate that up. Now, if the accountant's trying to save you money with less net income, and the banker's trying to give you a loan, how do you reconcile that? Right? Because you got to know that I'm going to need a loan. But you got to know 12 months from now that I need a loan. 12 months from now. Next year, I think I need a loan. So I need to start paying attention to debt to equity because that has to be at 2.5 or less. If I don't need a loan, then who cares what that number is? As long as you can afford the debt. So that's the question you ask yourself, do I need a loan or not? The last one on the balance sheet is mismatched financing. It is the silent killer of businesses. 60% of small businesses right now are misfinanced. Here's what I mean. It's using a wrong loan product to buy something. Would you buy a house with a credit card? Why not? Great miles. Come on. Think of the miles you're going to get on that. Huh? Yeah, right? Because credit cards are 15 to 20 or even higher now. Mortgages are 3, 4, 5, somewhere in there, right? 8, 9. So, but still, say it again. Okay, you could do that. All right, so on the home equity line. Okay. The point is this. The way to get something financed properly, here's the rule. The length of the loan should match the life of the asset. Say it again. The length of the loan should match the life of the asset, which means if you can depreciate something for 5 years, you finance it with a 5-year loan. Why? Because when depreciation runs out, so do your payments. Right? That way, if I want to upgrade or I want to do something new, I'm not saddled with losing depreciation or losing out on the payment side. The length of the loan should match the life of the asset. How you find it? Ask somebody, what'd you buy? How'd you pay for it? It's the change in gross fixed assets equals the change in long-term debt plus the change in retained earnings. Here's what that equation says. I bought something, and if I did it right, I use cash or I use cash and a long-term loan. Not my line of credit, not my credit card. The thing about mismatched financing, I'm going to tell one more story about this. No one ever walks out of their house in the morning and goes, I am going to misfinance my company today. Right? No one does that. It happened to me like this. I own 3 bar restaurants in St. Louis at the time. Go into one of them, there's just brown goo coming out from the compressor underneath it, all over the floor. It's out. If you know anything about these big 12-foot coolers, when the compressor's out, just buy a new cooler, right? So that's what I did. I jumped in the truck, went to the restaurant supply store, plopped down the credit card, said, put that baby in the truck. Went home or to the restaurant and saved the day. But I also financed my company. I put it on a credit card, something I could depreciate. I put it on the credit card and paid higher interest. It happens like that over and over and over again, where your clients will use their line of credit when they should be using a term loan. You can get out of that. It's called terming out your line. Anybody heard that? If you've messed up and used your line of credit in the wrong way, they'll usually give you a one-time get out of jail free card to term out your line. That doesn't mean end the line. It means convert the balance to a term loan and save you money. All right. The next one is a cash flow statement. Who uses that one? Yeah, nobody, right? They're going, yeah, I don't know why. You know why people don't like it? They can't figure out where the numbers come from. I don't know what that means. That's because we're used to the income statement where it's just start with sales, keep subtracting until we're at the end. The balance sheet is I either bought stuff and added to it or sold stuff and subtracted it, right? It's easy. It's what I call vertical math. The actual cash flow statement is horizontal math. All it measures is what was it last month? What is it this month? And what you're seeing is the difference between two periods. So it's horizontal math. That's why it's harder. You're like going, I have no idea where they got that. Well, if you had 200 in your checking account in January, and then you have 100 in your checking account in February, you'll see a 100. 200 minus 100 equals 100. So what I teach is a simple technique where you can read a cash flow statement in 15 seconds or less, just by looking at three numbers. Now, I call it the tattletale of the business, because no matter what story you tell me, I just look at those three numbers and it tells me the real story, where your money came from and what you did with it. You're like, how does that work? Well, this is the summary section of a balance sheet. Operating, investing, financing. Operating activities is how your money makes money with your business, right? Your core business activities. Investing is how you use it. When I buy a truck, when I buy equipment, those type of things, that's an investing activity. Financing is, how'd you get money to do this in the first place? Owners got some money in, banks got some money in, whoever it is. So those are the difference between the three. But if you look at it, it'll say, here's the summary section. Here's how they ended. Operating, investing, financing. If you can tell the difference between a positive and a negative number, you can read a cash flow statement. Operating activities is positive or negative. Okay, negative. So I would put a minus, right? Just a minus sign right next to it. Investing activities, positive or negative? Negative, another minus. Financing, positive or negative? Negative. Minus, minus, minus. If you keep it in that order, operating, investing, and financing, there are only 8 combinations that could exist. Only 8. So what I do for you? Built a legend. If you see that, right, like, where's it at? Minus, 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 I tell you what's happening, right? It says, hey, the company in this case is covering shortfalls in operation, right? That's what the negative operating is. Covering shortfalls or losses in their operation by selling their equipment. That's why that's negative. And they're still paying down their owners or paying off debt to their owners. That's what that means. And it's all spelled out in the legend over there, how it is. If you go get the book, it's in there. Get the book on the website, it'll be in there for you. All right. So that's the home run financial system. If you don't have the book, go get a copy on the website, and all of those calculations are spelled out in detail, how to use them in your business. So it's cashflowmike.com. There'll be like a header video right underneath it is download the book. So all of that puts me in the position to have the 7-minute conversation. I take those 6 calculations. Remember, I just touched all the bases. I just used the income statement and the cash flow statement and the balance sheet to learn more about somebody's company than they even know. I can go up there and say, hey, listen, looking at your company, looks like sales are down, gross profit's down. You did cut operating expense, that was good, and net profit's down. That's usually a result of not having enough money, right? Not having enough money and not cutting enough. You see how easy trends was to explain to somebody? Just that. Now, then I go over to expense control. But let's look at it. you had $538,000 less to spend. You only cut $416,000. That means we're short by $122,000. I need you to cut $122,000. Let's go look for it. The next one is debt to equity. Hey, we're in great shape. You know, when I look at it, we're at a 1.45. That needs to be at a 2.5 or less. And Mr. Client, let me explain to you. This is telling you how much you believe in your company. The lower the number, the more you believe. Because the banker's going to look at it as, if you won't put money in this company, why should I? So the higher the number means you've let the bank put in more money than you, or than that you should. So at 1.45, that's pretty good. You got room for a loan if you need it. How much can he take? About how much? How much more debt? Anybody figure that out? What was the answer supposed to be? Or less, right? He can take on what? Another $1.05 of equity. So if equity is 1,743, he can take 1.05 of that and have that much more debt. Not suggesting it. There's other variables involved, but that's kind of how you read that. The next one is EBITDA. EBITDA, we're doing actually pretty good. Everything was looking up. Actually, EBITDA was popping up, and we're positive there on EBITDA year over year, looking at the changes. And then mismatched financing. Here's something cool I found. We found some mismatched financing. What did you buy? How did you pay for it? And they're going to tell you, oh, well, I bought this here truck and I put it on the credit card. What's the answer to fixing that guy's problem? I bought this here truck, put it on the credit card. Hey, let's go talk to the bank. Let's move that off your credit card so you're not paying 20% interest and go get you a 10% or 9% or wherever they are now truck loan. And it's going to save you X $100 per month. No more new debt. You're not getting new debt, more debt, same debt, put in the right bucket. All right, the last one is cash flow activity pattern. Okay, get closer so I can read it. What I looked at is you got minus, minus, minus was a pattern. Doesn't mean much to you, but here's what it is. Your company is using cash reserves to finance your operation, operational shortfalls, and paid long-term creditors or investors. That's exactly what I told you it would be, right? It tells you a sentence of what's going on. So no matter what story your client says, you can back it up with the cash flow statement. Here's a question. You think that'll help you? I use it two different ways. One is in a monthly check-in, right? Monthly check-in with my clients. Two, I use it to close deals. People come in and says, well, I can do these bookkeeping, I can do this accounting, I can do this type of stuff. I'm like going, I don't know what I can do yet. Let me look at your company. And in 7 minutes, I tell them that. No other accountant's telling them that. No other business owners looking at their business like that. Using the entire breadth of all financial statements together in a 7-minute conversation. So if you want to differentiate yourself, I would do it at least annually with a client saying, hey, here's where you were last year, here's where we are today. And when you're comparing multiple companies, remember my dilemma, how this came about. 100 companies' financial statements sitting on my desk. What do I do next? I can't do deep dives on every company. This tells you who the good company is and who the bad company is right fast. I do 7 or 6 calculations. Yep, just start sorting them. Who's good, who's bad. So, finishing up with, to create order in chaos, you have to clear the noise. And I heard somebody else say that before. Clearing the noise is important because if you sit down with your client, they got things they want to tell you. It can't always be your plan. They're going to come in and say, hey, I'm having a problem with pricing, and you wanted to talk to them about forecasting. Guess what you should be talking about? Because that's the noise in their head. Help get back on their level. Clear the noise. So, thank you.